Hello and welcome to this interview session on the future of ESG investing, which aims at framing the panel debate on sustainability, which is coming up next. I'm delighted to have with me Jessica Grant, Global Head of ESG at Capital Group, which is one of the world's oldest and largest active fund management organizations with more than $2 trillion in assets under management. Jessica has more than 20 years of experience in the industry and was previously global head of stewardship at Schroders, where she had a successful career as an equity analyst and portfolio manager before focusing on ESG. Jessica holds several industry leadership positions, including board member of the Investor Forum. Hello, Jessica.
Hello. Thank you so much for having me this afternoon.
It's a pleasure to have you here. Jessica, 2020 might have been the year of the pandemic, but do you think it will also go down as the year ESG investing reached a takeoff point, so that we are not going to see an even stronger acceleration towards a future where all investments will have to account for their impact on the environment and society?
I definitely think that the pandemic 2020 has marked something of an inflection year. Like so many other areas of our lives, the pandemic has caused an acceleration of existing trends. So if you looked at something like online shopping, we were all doing it before, and now I'm afraid every time the doorbell rings, it's another parcel coming on. It's a little bit like that with sustainable investing. The trend was really strongly there, but I think the questions that the pandemic has risen about what's a sustainable economy, what's a sustainable company, has just meant that it's become much more ubiquitous.
Mm-hmm. And do you think the pandemic has brought a kind of rebalancing of E, environmental issues, with S, social issues, and perhaps all three ESG factors are now more equal in terms of investors or asset managers' focus?
So the challenge that I always found when there was talking to either companies or clients about S issues is that there were just so many of them. People sort of struggled to think about, it was about how you treated your employees, how you treated your supply chain, your relationship with the regulators. And if you like, the pandemics provide just some great real life examples about companies that manage these things really well, go on to create value. And of course, nothing like real life examples just really shows the utility of something. So I think it has been very helpful in illustrating why it makes sense for a company that we're investing in to really have sustainable relationships with all of those different stakeholders. And you can see where it's pointed to the value that is created in more resilient supply chains, being able to still manage workforces during this difficult time, and where it's paid dividends.
And because the definition, as you say, of social is so fragmented, so varied, so what are the challenges in including social factors in the investment process? There is an urgent need for global standards, even more perhaps in the social space than in the environmental space.
I think you're right. So to some extent, in the environment, it's easier to measure, sadly, things like environmental degradation and pollution levels. And social issues have been harder to measure. But I would point to some of the things that we're trying to do around harnessing unconventional data to look at some of that in a better way. So, a well-cited example, which we're not alone in looking at, is looking at things like Glassdoor data to measure how well a workforce is being managed, to look at media mentions, to see perhaps how companies are being portrayed by other stakeholders in the media. So I think the combination of these issues being brought into focus and some of the really interesting things that we can do with unconventional data to harness and fill up a picture of that will slowly start to mean that we'll be able to put social analysis on the same footing as we are on things like environmental analysis as well.
Mm-hmm. Looking at engagement has been a relatively standard way of operating for certain investment approaches. But how has it evolved amid the COVID-19 pandemic in terms of perhaps subjects of discussion and pressure? Do you see that it's becoming more activist engagement with company?
I love to say that I've been investing for almost a quarter of a century and I've yet to meet a perfect company. So engagement is incredibly important in terms of your fiduciary duty and in terms of actually how you get change and create value. I think what's so interesting is if I look back on 2020 on the trends that we saw in engagement, in a way it sort of maps so well to some of the trends that we've seen in markets and in the wider pandemic. So a lot of the engagement at the beginning of the year was very much crisis management. How were companies tackling the pandemic? How are they treating their workforce? How are they working with their suppliers? And how are they ensuring resilience? Naturally some tough conversations. Not all companies get it right, and tough conversations as well during those times about where companies need to get back on track or things that they need to do to make themselves more resilient. And let's not forget the importance of the governance during this. It was really clear during this period which boards had great expertise and were able to help navigate. I think what's been so remarkable in the period after that initial crisis period, how much engagement business has reverted to normal. So doing huge amounts of engagements on issues like diversity, particularly with the events of the summer of racial diversity as well, really assuming a new urgency in some of the conversations, and continue to engage on things like on climate change, particularly against a backdrop of a sort of changing regulation. So it really shows what a powerful tool engagement is. In the beginning of the crisis, it was really helpful for helping us understand which of our investments were going to weather the storm in a better way. And in the second half, it's been much more about what are the strategic priorities? Are companies still making great progress with these strategic priorities? And how much are they able to revert to normal? So as well as a practical things that we hope to get out of our engagement, there are some really other interesting signals there as well.
And do you think that the exclusionary approach and shareholder activism should work together, or are they mutually exclusive? What happens if companies do not follow your recommendations? Do you exclude them automatically from your funds?
Well, I think there are lots of parts to that question. So I guess the first thing that I would say is activists can be quite a loaded word, and there are all types of people who would consider them activists or arguing for change as appropriate, including engaged active fund managers like ourselves. And some people are very, very public about their campaigns. We're just seeing a campaign launched for Exxon, the US company, that's just sort of been funding in an activist way aimed at changing out the directors there. But just because people are shouting loudly doesn't mean that there aren't other people there pushing for change. So yes, activists are very high profile. Yes, we can see more activist activity. And yes, we can see things like more shareholder proposals. But I think I would also almost look at that as the tip of the iceberg. And I think there's a lot more really exciting dialogue happening with companies that's really rich, more so than ever before. Then I think the other question is sort of what's better? Is it to have that kind of a dialogue, or is it to divest? And the thing that I personally passionately believe that systematic issues like climate change, the scale of the change that we need to happen, that just divesting a few companies is not going to be a catalyst for that change. Particularly when you think it's equity capital and it's permanent capital, selling out of an oil company enable that company to have a successful energy transition. So there's a huge role to play. And I would also say there's a huge role for long-term shareholders to play. We typically invest in companies for a very long time. And we know that quite often to get for change, that's got to be sustained. So a real role for not just activists, but long-term engaged shareholders to push for change. And it's a lever, obviously, that divestment doesn't provide you. Although, of course, I've had many situations in my career where you just feel that actually a company isn't going to change. And what's lovely about being an active fund manager is you do have that option as a last resort.
Mm-hmm. And do you think this fear of a bubble in ESG assets is justified? Or do you think supply of ESG investing will be able to match demand for this kind of solutions?
That's a great question, and I think one that happens against the backdrop of markets as a whole are on we're seeing a number of companies hit some quite high valuations. So I don't think it's just sort of, you need to put in the context of the whole market when you look at some valuations. I certainly think we see really strong demand for ESG assets. I think if you look at things like green bond issuance, that's been very strong. And then there's some advantage that there's some indication there on some of the research that we've done that actually companies can get a real advantage by going through green bonds because the demand is there. Again, it's one of the great things about being an active fund manager is that we don't have to leave our assessment of value behind us, and we can really pick not only those sustainable companies that we think are really interesting from sustainability profile, but also are going to make attractive value from a valuation. So we have seen large flows into things. We can see some places where sort of green assets are commanding a premium. As an active fund manager, I think it's really incumbent on you to still make sure that at the end of the day, sustainable investments, are the people who are saving with us are still looking for us to generate a return so that they can have a sustainable future. So it's really important we don't just throw valuation out the window.
At what stage of the investment process do you take sustainability factors into account? Is it more in the quantitative screening or in the qualitative assessment? What's the best way?
Yeah. So again, my experience of having run portfolios myself and what we've built at Capital Group is very much about integrating it at all the stages. One thing I really believe is that if you want to integrate something really well, it can't be an add-on. At the idea generation stage, really understanding fully and deeply researching as we do a company, understanding historic controversies and using our frameworks that we've developed, understanding how those companies are managing future ESG risks, regulatory monitoring the portfolio to see if there are emerging risks and asking ourselves questions about whether or not those are in the valuation. And then regularly identifying areas of weaknesses and engaging with companies in them. And, throughout that, still seeing if an investment is attractive. So I always say that ESG is never something that's just one and done, and you can't stick it on at the end. You've got to have it right through the idea generation, that ownership, but also really important keeping on monitoring your portfolio because our understanding of new and emerging ESG risks is continually innovating.
Mm-hmm. We have just over a minute left, but do you think that the perhaps the best is yet to come in the sustainable investing space? What kind of what do you expect this year may bring in terms of looking at for example, the UN Climate Change Conference, COP26, and ambitious government's plans and Biden administration? Are you optimistic about the future of ESG investing?
I think it's probably the most fascinating area of investment that you can work at right now. And I think those of us who do that are really privileged. Two things, really. As you said, some of these sustainability issues are really making the policy backdrop, the weather against which we invest, and understanding these types of structural changes that are created by sustainable issues is just a fascinating thing for any investor to spend their time on. And then the second issue, I think there's some really exciting tools, and I've touched on this idea of harnessing unconventional data to help us understand companies' impacts better, how companies are operating much better, which also makes it really exciting. So there's just so much innovation happening. I think our understanding of some sustainability issues will sort of look back in 10 years and think that we were just taking baby steps. And I think there's going to be tremendous progress, which is really exciting.
Thank you very much, Jessica. On this positive note and the hope for a greener economy and more sustainable society, I'd like to thank Jessica Ground for this insightful chat and the viewers for your attention. Please stay with us for our next session, which will start in 5 minutes. It's the panel debate on why 2020 was a turning point for sustainable investing. And see you later. Thank you.